Over the past 2 decades, investors have suffered from a curse, and it's one of mediocrity. There's a saying on Wall Street that nobody can beat the market. Well, unfortunately, data from the little guy tends to prove that point, but we can change that, and with just a few simple tweaks to how we look at things. Hi, I'm Matthew Carr, Chief Trend Strategist for the Oxford Club, and welcome to this episode of Market Trends. Now, since those lows in March, the markets have been on a tear. They've essentially gone in one direction, just straight up higher. The NASDAQ is at all-time highs. It blew through 10,000 and has 11,000 in its sights. Everybody is cheering. Everybody's making money. But I believe this is a moment that we really should take a step back, take a breath, refocus and recenter ourselves, because we have to remember it isn't always such a rosy picture for the average investor. In fact, according to the Dow Bar Annual Quantitative Analysis of Investor Behavior, Jane and Joe Main Street have a tendency to underperform the major indexes. And in fact, the average investor underperforms the S&P 500 by a wide margin. And I'm talking both the short term and the long term. 3 years, 5 years, 10 years, 2 decades, 3 decades. The average investor continues to step up to the plate and swinging, but unfortunately, the results have a tendency to continually come up short. But here's the really frustrating part. It's not because the markets are rigged. It's not because fees and taxes are too high. It's not because there's a lack of valuable information to profit from out there. The reason for the shortfall is investors themselves. Looking at this pie chart, we see the single biggest reason for the shortfall is psychological. These factors account for 50%, half of all of that underperformance. And when we dig deeper into the data, what we see is that it's the same biases and bad habits that are repeated over and over again. And I'm talking mistakes like loss aversion. Our brains are actually hardwired to avoid losses. So we have a tendency to take gains too quickly and to hold on to losers for way longer than we should. Studies have shown that we actually feel something akin to physical pain when we take a loss. And if you've been in the market and you've taken a loss, you know it, you can feel it in your gut. So investors tend to do everything that they can to avoid taking a loss. We don't want that to happen. Now, this is why I always stress that we use trailing stops, because they are emotionless, mechanical, and robotic. When that stop loss is hit, just move on and don't even worry about it. You don't let that bring the rest of your portfolio down. Herding is another big contributor to this underperformance. Herding is, panic selling or chasing a stock higher. This is the hallmarks of the really, really ineffective strategy of buy high and sell low. But a lot of investors have a tendency to fall into it. Now, I will also say that there's a lot of herding going on in the markets right now. You can see that in the day-to-day moves, not only of the market itself, but of like single stocks where we have these massive gains, 200, 300% or more, and as well as these big, huge drops. I'll also say that at the moment, investors are piled into and concentrated into 5 stocks: Apple, Amazon, Alphabet, the parent company of Google, Facebook, and Microsoft. They're concentrated into these 5 stocks in the S&P 500 more than any other time in the history of the markets. And that is kind of a sign that you do have to take notice of, and is a warning sign that, because once those roll over, that's when the larger markets have a tendency to roll over. Now, loss aversion and herding are 2 of the biggest factors for the underperformance of the average investor. They're also the biggest drivers of what we call the investor psychology cycle. Now, real quick, this graph right here, I believe you should have printed out and put on your wall, or it should be the wallpaper on your trading computer, because all of the damage that the average investor does to themselves is right here in this graph, as well as all of those opportunities. In fact, at that point of maximum financial opportunity back in March, I wrote an article to my subscribers saying that we were approaching that point of maximum financial opportunity. So this is something that you really want to have around you and be reminded of, because when we have those moments of despondency, as well as those peaks of euphoria. Euphoria, that's where like you should definitely be fearful. Despondency, that's when you should definitely be greedy. Investors have a tendency to repeat this cycle over and over and over again, and we see that play out in the markets through both bubbles, those bubbles bursting, and collapses. But I also want to say that loss aversion and hurting aren't just the only mental factors that affect investors and their underperformance. We also have narrow framing. This is making a decision without considering the overall impacts to your portfolio. This is why we also stress things like position sizing. We have anchoring. That's focusing too much on the past and really lacking the ability to adapt to the changing market. All of those financial talking heads, which I'm surprised that they admit that have been sitting on the sidelines since February, March, this is what they are guilty of. They've been unable to adapt. They're too afraid to adapt to the market. And then once it blows past you, you're just sitting there going back to that investor psychology cycle, being like, oh, well, it'll eventually come back. It'll eventually come back. You're just waiting for it to all play out. And sometimes that could be years. So there's something to be very cognizant of. Then we also have really silly, simple mistakes like mental accounting, as well as a failure to diversify, which I've talked about in the past with position sizing, media response, regret, and plain old simple, overly optimistic expectations or assumptions. All of these are the enemy of the average investor, and these are what really impact your returns. But now you know what to look for. And for all of us that grew up watching the old cartoon G.I. Joe, we know that knowing is half the battle. Go Joe. The markets have been on fire the past few months. Day traders, novice and veterans alike, their palms are sore from high-fiving each other so much. But you want to make sure that in this environment that you are not making these common psychological mistakes, because these are what really lead to the average investor's underperformance over the short term and the long term. I'm Matthew Carr, Chief Trend Strategist for the Oxford Club. Thanks for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's the high returns.